Hello, everyone. Welcome to today's webinar, an inside look at qualifying for financial aid. We can get started here in a minute. A lot to cover today. Whether or not you've saved a little bit for a child going to school, haven't saved. You have younger children, or a child, senior going into college next year. There's gonna be a lot of great information here to kind of get you to start thinking about this process, or to get really just get you started. Quick reminder: the opening date for applying for financial aid, and it's kind of timely we set it up this way, it started on October 1st. So everything you're going to see here is really kind of like the homecoming, the getting started point for getting ready for college and applying and that whole process. And I will also say that we'll have a lot more resources to help you along this process. So if you wanted to stay in tune with that, just email me. I'll get you my information here in a second. Let me know. Sign up, go to our website, sign up. We have what we're calling the College Planning Hub. We'll have important timelines, important dates, deadlines, and a whole plethora of information that'll help you through this process. So just a real quick note about me: wealth advisor with at Bautis Financial, 5 years in the industry, and probably more importantly, a father of 4 children. And although they're young, they're all 4 and under. I have a deep respect for what some of you either were going through or are going through today, and we at Bautis Financial have taken note as to how stressful and how important this process is. So we've really stepped it up and put together, like I said, a lot of this information, and this webinar is part of that. And really today is a lot about debunking a lot of the myths. There might be thoughts you already have about this process, and one of the biggest is when this process starts, is that a lot of families will simply rely on luck. They'll let their children apply for any schools they would like, and then keep their fingers crossed, and fingers crossed that their children get accepted and receive large awards to make college affordable. Sometimes it works out, but often it doesn't. So unfortunately, poor college decisions can ruin a family's financial situation in some ways. So let me state the obvious here: this luck is there's a better way to approach it. It's not a very good plan. It's far better to understand how to research the generosity of these schools well in advance of applying. And a critical first step in this process is to understand if you will qualify for financial aid. You may assume that you know the answer to this question, but often parents don't. The more expensive the schools that your child is aiming for, actually, the more likely you will qualify for need-based aid. And so if money is an issue, you need to answer this important financial aid question, because it will help direct you to the types of schools that your family should be exploring. We'll get to a little bit more of that in a minute here, but parents often assume that there must be some sort of magic number, right? This income figure that will disqualify for them for financial aid. Could it be $100,000 for the household, 150, 80,000, something else? This process would be a lot simpler if there was a specific number, but there is no income or asset cutoff that disqualifies a family for financial aid. And the financial aid formulas are just way too complex to generate a yes or no on this question based on an income figure. To answer the financial aid question, you need to determine what your expected family contribution is. This is sometimes represented as an acronym EFC. And an expected family contribution is the dollar figure that represents what a financial aid formula believes a household should be able to pay for 1 year of a child's college education. So it's what this formula will generate what you're able to, colleges should expect you should be able to pay. And it's based on a bunch of different factors. Number one is how many children you have in college. Your adjusted gross income of the parents, adjusted AGI, obviously as stated on the taxes of the parents, the AGI of the student, and the assets of the parent and the student. And there are 2 formulas that come into play here. There's going to be 2 formulas where this EFC will get calculated. The federal formula is tied to what is called the free application for federal student aid, sometimes represented as FAFSA, which many of you have seen. This is the federal aid application that students must complete to qualify for federal and state aid, as well as institutional aid at a vast majority of the colleges. Now, there's a second formula, which is the less common, but it is out there for a lot of these, some of these more like brand name type schools. And it's the institutional formula, and it's tied to what they call the CSS profile. And there will be specific schools where you'll fill out this application, the CSS profile, and these schools are you going to use that formula specifically. And sometimes the formulas generate similar EFC contributions, but other times they can be significantly different because of the formulas are going to focus on different factors. So it's important to know the difference there. And they're if you are considering schools they're going to consider both these formulas, of course, I would consider filling out both. I'll give you an example of what an expected family federal expected family contributions are possible. I'm going to take a look at this middle class family with modest assets can generate. So we're going to have this middle class family, $55,000 of adjusted gross income, and cash and taxable investments that are available of $15,000. And this is what that family or household would generate as far as an EFC. So this family could expect to pay roughly $2,500. Parents could expect to pay roughly $2,500 towards a year of college for that one child. And the CSS, or the institutional method, would show roughly $1,600 for the parents and $800 for the student. So in this case, you're seeing a little bit more towards the student, but it's fairly similar. And this as you apply this to just to bring this example to the next step, which is going to be is showing what it would look like if to a specific cost of a private college, which would be roughly $60,000. Because this family is expected to pay $2,500, the difference would be $57,500. So and that's the demonstrated need. Now, that doesn't mean every college is going to necessarily give you that $57,500, but this is what you could expect to see in this example of, the college is going to get this and they're going to say, all right, like this is what their need is. And then they're going to take their, we'll get to the next part as to how all the colleges are going to address this, but that's what your EFC would show. And then let's take another example of, on the other end of the spectrum, a little bit more of a higher income family with $150,000 of gross income, taxable investments and cash of about $120,000, and some home equity, which they will consider as well, of $250,000. So in this example, you obviously you can imagine there's going to be a much different result. So here you're going to, in that example, they're going to be expected to pay $31,000. For the federal methodology and the institutional methodology, roughly $33,000. In this example, as you can see that the actual the IM has actually shown a much higher result. In that same example we just showed you before, that obviously you're going to then take that $60,000 and you're going to give yourself a rough idea as to, all right, the colleges are going to see that our financial need is roughly $30,000 on the federal side, and closer to maybe $25,000 on the institutional side. And then let's just look at two kids, the same family we just saw. One of the things we get is a lot of times parents are like, oh my gosh, I have I have two kids, and the good news is if you're going to have two kids in college at the same time, is it's daunting, but at the same time they will consider that you have this higher need because you are paying for two children. So in that same case, it almost cut in half for the federal methodology, not quite as much on the institutional side, but it will take in consideration how many kids and how many children you have and are paying for in college currently. Now, as you can see in this slide, the more this kind of just reiterates what I was just saying before, is like, 2 students, 3 students, it'll show you like the percentage of like how that will drop as you're going through the different, with the different, how many students you have in college. A lower modest EFC indicates you have less financial resources to pay for college, of course. So families in this situation should be looking for schools that provide excellent need-based aid. So if you show a low EFC number, there's going to be specific schools that will actually show that they're historically are paying more towards for need-based aid. And that's what, when we refer to that, what's what we mean by need-based aid is showing that you have, relatively speaking, a lower EFC, so you're expected to contribute less. These are going to be like, this would be like a high need situation. And there's going to be certain schools that are going to be just historically more generous in those situations. So be aware that the state universities outside of your borders are highly unlikely to provide need-based aid to outsiders. And it's just a nature of the beast. And these state schools outside of your border are typically only going to provide merit aid to non-residents. And I'll get to merit aid here in a second. If you discover that your EFC is on the higher side and money is an issue, you want to look for private and state colleges in and out of your state that provide merit-based scholarships to affluent students. So most schools fall into that category, except for the most elite institutions, which don't provide scholarships to high-income students because they can attract many wealthy students, with this, idea that they're this more popular school, which we'll get to in a second. But, that merit base is going to be just based on how well the student has done, so in this larger expected family contribution situation, if money is an issue, you're going to want to look to those schools who historically have paid out more on the merit side, because they're just not going to be, unfortunately, you're not going to be in a situation where there's going to be as much need-based aid available to you. So, with all this, it's important to obtain your EFC as soon as possible for 2 important reasons. Number one, obtaining your EFC will give you an idea of what kind of money, schools will expect your family to pay, at a minimum for 1 year of college. And number two, it will provide you a direction on whether you should aim for schools that provide excellent financial aid or aim for schools that provide merit aid that is given regardless of financial need. So how do we generate this? Well, the best resource to obtain your EFC is on the College Board's website. To generate the most accurate results, you'll need your income tax return, your non-retirement investment accounts. Some of those statements, just know what the amounts are there, because have that stuff ready, because that's what they'll be asking for you in the questionnaire to generate that EFC. If you want to do the calculation yourself, of course, head to the website where you can find the EFC calculator. It's pretty easy to find there. You can just look up College Board or Google College Board website and you should easily find it. It can be a little tricky. So if you like some assistance, of course, we're here and we'd be happy to help you to sit down with you and just figure that out for you. Just to make sure that we're getting all those numbers correct and make sure we're getting through that properly. So here's one or more reasons why your EFC is valuable. Your EFC can also be incredibly handy at the tail end of the admissions process when you've received your financial aid awards. You won't know if a financial aid package is stingy or awesome or somewhere in between if you don't know what your EFC is. So you get this number back and you have a comparison. So financial aid letters often don't include your EFC. So like they're not going to say, hey, look, this is what your EFC is what we awarded you. So you can, by having that number, you can give yourself a better idea of the comparison with your EFC. So in this example from Pace University, the student's EFC is 0, which means the family's AGI is $25,000 or below. So there's a great need there. So the student, they receive a grant totaling $33,000, which might seem generous. It's 33 grand, but But when you can compare it to the AFC, it might not have zero. And you look at the situation, the letter states that the student's cost for 1 year would be $28,900, and that exceeds the family's income completely. So, having this, this number as part of this conversation, and understanding how generous these packages are when they're coming back, is also an important factor here as well. And the other question we get is like, is investments and how much they're going to hurt your ability to get aid. So lots of parents are naturally worried about this, that how much these saving and is going to affect how much aid there will be. And naturally, because you think that, all right, I have this money sitting there, is it going to, are they going to, how are, these schools and is this application process going to address it? So I'm going to take a look at what the, just really quick here, just to let you know what it ignores. So there's gonna be certain things that, like, I really believe that some people think is going to be a factor that aren't. So neither the federal formula, the FAFSA, or the CSS profile penalize families for their retirement, such as IRAs, SEP IRAs, 401ks, 403bs, pension plans, so on and so forth. So you could theoretically have millions of dollars in retirement accounts that will not affect this calculation whatsoever. So that's good news. So save away for retirement. Don't even worry about it. The FAFSA also ignores annuities, the cash value in life insurance, and the assets of a family-owned business with less than 100 employees. The FAFSA also doesn't count equity from a primary home. So the FAFSA, it won't ask if they own a primary home. You should include your home equity when asked about your assets on the FAFSA. The FAFSA, however, will treat the equity in vacation homes and rental properties as assets. So anything outside of any property equity and property you have outside of your primary home will be counted. So just to clear that up there. And if you're divorced or separated, the FAFSA has special rules regarding financial aid that is, in some cases, can boost your chances for financial aid. Here's a big advantage. Only the custodial parent will fill out the FAFSA. So only the custodial parent's assets and income will be counted for financial aid purposes. So if you're in that situation, something you should seriously consider. The hired world relies on an unusual definition of custodial parents. So just like to reiterate on this, that let's say the FAFSA will be submitted on February 1st, 2022. The parent who completed the FAFSA would have been would be the parent who would take care of the child for more than 6 months going back to February 1st. So these are kind of those rules of what we consider a custodial parent. So let's use an example to see how this custodial parent this custodial rule will play out. So let's say we have the mom who's a physician who makes a hefty salary, and the ex-husband is a high school teacher. If the family wants to reduce their cost, it would make sense for the teen to live with the dad, or work within those rules. That 6 months of staying with the dad, so he would then qualify as the custodial parent. So that if the dad qualifies as the custodial parent in this case, the mother's higher income as well as her assets would not be divulged in this FAFSA. So as you can imagine, as we're looking at this, it's important to understand that who claims a child on their tax returns or pays a child support is irrelevant when determining this custodial parent. So just an important factor. And if you want to talk through some of that and trying to, because this is one of those ways where you could switch some things around to make sure that there is, in this divorce situation, there is a way that you're positioning yourself based off of the difference between the two parents, their assets and their income. The household size does impact financial aid as well. So you should count stepchildren in a family, even if they live elsewhere. If the custodial parent or parents provide more than half of their support, this is something to consider. So, definitely look at, the household size and consider all of that, because that will affect this as well. The CSS profile, which I mentioned earlier, is an additional application that mostly selective private schools use. The CSS profile does consider more assets than the FAFSA, so it's going to that those assets are going to affect the formula a lot more than the FAFSA. The CSS profile does ask about home equity and the adjusted net worth of a business or farm. And some CSS profile schools will consider the cash value of life insurance and non-qualified annuities. So they're a little bit of a curveball there. Some of them will consider that, but just a little bit of different approach on the CSS profile side as far as how those assets. And when you do look at the difference between the two, if you have a little bit of, you have some savings saved up, the difference, you'll see a bigger difference between the CSS profile EFC and the FAFSA EFC. So let's take a closer look at how the CSS profile treats home equity. So many schools that assess home equity for financial aid purposes do so by linking it to the family's income. For instance, a school might assess home equity at no more than 2 times the family's income. This way, the formula is less likely to hurt families that are house rich and cash poor. So let's look at an example of how this would work. So you have a family income of $60,000, home equity of $200,000. Schools that use the CSS profile formula assess home equity as well as other parental assets at about 5% for financial aid purposes. So if you take that $200,000, which the CSS profile home equity is going to include as assets, we're going to look at 5% of that, which would be $10,000. So in this example, the home equity value would have boosted the expected family contribution by $10,000. This would be a huge financial hit. So, but then let's look at what happens if the school is tied to home equity assessment to no more than two times the family's income of $60,000. So, of course, in this case, we have $60,000 times 2, which is $120,000. So in this example, the school would only use $120,000 of the home equity in this family's financial aid calculation. So here we're looking at $120,000 times 5%, and this will come out, of course, to $6,000. So in this example, the parent's EFC would increase by $6,000 rather than by $10,000. So it's important to ask these schools what their policies are regarding home equity. So there could be some differences when it comes to this CSS profile. So it's important to know how that's going to play in. In most cases, the FAFSA is going to be a little more cut and dry, and there can be some differences in the CSS profile. If your child applies to schools that also require filling the CSS profile, the rules on divorce may vary as well by school. So some CSS profile schools would treat divorce just like the FAFSA. So like no difference there, but many of the schools, many of these CSS profile schools will want the non-custodial parent to share financial information by completing what's called a non-custodial CSS profile. And you can find the schools that require this non-custodial aid application by checking out the list of CSS profiles on the CSS profile website. Another great resource when it comes to these situations. Of course, starting there is a great place to start when you're looking at schools to see, if the school that you're looking at is going to require the CSS profile just in general. But this will also, if you are in a divorce situation and you want to find out, you're going to want to find out whether or not the schools you're looking at and highly considering are going to typically consider the non-custodial aid application. So something to consider there. And of course, as we go through any of this, if you have any questions on this or want us to help you find any of these schools or some of these schools that stand out that are different, of course, please let us know. So the FAFSA and the CSS profile both agree, and they're both on the same page, that some assets need to be considered in aid formulas. So we kind of went through the differences and some of the things that are going to be that are going to be either counted out. But in this case, the FAFSA and the CSS profile both agree they're both going to be considered in the aid formulas, which is going to be child assets, so that any assets the child that has saved up or has in their name, taxable assets, trusts, and college accounts. So, of course, the 529 would be included in this. So let's take a look at these a little bit deeper. First, I can't emphasize enough that for most families, parents, non-retirement assets will not hurt their chances for financial aid. And that includes the 529 savings plans. Now, saving for college will provide you more college options and will make it less likely to have to borrow for a bachelor's degree. Now, even though these will slightly be a factor, I guess the takeaway here is like, you don't want to decide to not save for college. You're always going to be better saving as much as you can. And we're going to show you a couple of examples of how that's going to play into these financial aid packages. Saving for college is the smartest move, because you'll just plain out have more choices. For every $10,000 you save, need-based aid would only be reduced by $500. So, think about that. It's like you have $10,000 and it's only going to reduce your need-based, the need or the FC by roughly $500,000. I mean, in the grand scheme of things, it's way better to have that $10,000, because it's going to give you more options. And it's a very small percentage of how it's going to affect your eligibility. There's another factor at play here, though. The FAFSA formula shields some of the parental non-retirement assets from being considered at all. How much parents can protect will depend on the age of the oldest parent on December 1st of the year the FAFSA is filed. So in this situation where the oldest parent of a married couple is 50, on 12/31/2021, the parents could shield $7,000. So you see it kind of just rolls down, as you're getting older, and really what's at play here is that you're going to be looking at roughly, as you're getting closer to retirement or as you're getting older, your need for this money is going to become greater. So you're going to be in a situation where you're going to be able to shield a certain amount of that, a certain amount of those assets. All right, in this example, you can see that even a large amount of money saved up can have a rather modest impact on a student's eligibility for financial aid. So, if the parents are 50, so it's going to go through those calculations, and it's actually going to reduce the amount. So you can see in this case, there's $80,000 that they have saved in a 529. And because of that chart I just showed you, it rolls down to $7,000 at age 50. It's going to take that $80,000 down to $73,000. And then the formula basically is, and one of the things you can use in your head is going to be that 5%. It's actually 5.64% of your savings. So your savings that the FAFSA or the CSS profile are going to consider is going to be roughly 5%. So for every dollar you save, the FAFSA is going to consider 5 cents on the dollar. So again, just fairly small, but definitely a consideration. And in this case, it's even lower because it's taking that dollar amount down by that rolling scale. In the second example, the parents' assets have zero impact on the student's chances for need-based financial aid. That's because what the parents have saved up is less than their federal asset allowance. So if they have $8,000 saved for college in a 529, and you roll down on that scale that I was showing you down to where they're at 8,400, because that asset allowance is higher than what they actually have saved, it's completely irrelevant. So just a couple of examples there to show you how that's going to play in, and considering how much you have saved, I think that it's going to be, something you're going to want to consider, and you can kind of almost eyeball before you even figure this out. But I will say that as you go through the AFC, it's going to figure a lot of this out for you, but just to kind of understand some of the nuts and bolts as to like how it's figuring all that stuff out. The CSS profile methodology also shelters some of the parents' assets automatically, but just how much isn't known. I mean, the CSS profile is a proprietary formula, and some of it is actually kept secret, so it's a little bit harder. But the CSS profile does assess unprotected parent assets at 5%. So it's just a little harder to understand how what that bucket of assets it's going to consider and apply to the 5%. So it's even more important to understand, going back to what I was saying, understanding how the school is going to look at home equity, do a little bit of research on how the CSS profile has turned out at aid, but also consider that it is going to be at 5%. It's best not to have money in a child's name, because this money is treated more harshly, actually. So, the aid application will be interested in the value of the child's assets. They're supposed to be based so basically the child's assets that are on the day of the application are filed. So they're going to take that amount into consideration. So, just one of those things to consider, how the student, how much assets the student has in his name. So it might be important to understand how those accounts and how much money is in that student's name, and possibly like working to shift the money around. So just a quick example here. A student's money is assessed, like the CSS profile assesses the student's assets at 25%, and the FAFSA assesses them at 20%. So unlike their parents, the students don't have an asset protection allowance as well. So like they're not going to have that rolling scale to kind of reduce the amount they're going to consider. So here's an example. If a student has $5,000 in his checking account, schools would consider that to be $1,250 and $1,000 on the FAFSA. So, obviously, if you look at that $5,000 that was in the parent's name, we looked at, what would that be, $25. So, just considering how much, the different types of accounts and how much cash the student has is actually going to affect that number. And then we get to the student's income. So that the FAFSA formula allows students to shield all or a portion of their income. So for the 2021-22 school year, a student could earn up to roughly $7,000 for the year and not jeopardize aid. The CSS profile does not provide an income allowance for students, but it assumes the students will contribute something to their college education. Many CSS profile colleges require that students contribute in the $1,800 to $2,300 range, to their education, and this is regardless of whether they have a job or a savings account. So, a little bit of a different approach there on the CSS profile, and you'll see that in the results. You saw that earlier when we did an example where, there's almost automatically going to be something that the CSS profile is going to consider and want the student to contribute. And then that brings us to custodial accounts. And the financial aid formulas, while they do penalize money held in a child's name more harshly than parents' assets, most students that have, they're not really going to have enough assets for this to make, most are not going to have enough assets to make much of a difference. A major exception can be money tucked away in what they call a custodial account. And this could be, these accounts are most of the time going to have acronyms connected with them called Uniform Gift to Minors, or UGMA, or Uniform Transfer to the Minors Act, or UTMA. And custodial accounts are assessed for financial aid purposes as the child's assets. So as I mentioned, the FAFSA assesses the child's assets at 20%, and the CSS profile assesses them at 25%. So one way to limit the damage if a child has considerable money in a custodial account is to close down these accounts and pay any applicable taxes, and then move the cash into a custodial 529. And again, this is just one of those plays where you want to make sure that the type of account, and just look at the child's overall assets. If your child has a bunch of assets or has some money in these accounts, we'd be happy to help you move the money around. But the 529 will be will only be assessed at that lower number. So basically what we're doing is we're getting the money out of those accounts that will be addressed at 20 and 25%, and getting them in the accounts that will be addressed at the 5%. So, and like I said, if you have any questions on that or want us to help you figure that out, we'd be happy to kind of show you the difference and make sure that the accounts you're looking at aren't going to be considered at that higher percentage, and really just see if there's anything we can do to move that around. And one of the questions sometimes we get is talking about grandparents and their assets. And grandparents' assets will really impact the financial aid as long as the assets aren't withdrawn for college. It gets tricky, however, though, when grandparents begin to help with college costs, it gets a little bit trickier. The money that the grandparents use to cover college costs is considered the child's untaxed income. And this income is assessed at upwards of 50%. So definitely, obviously, something once your grandparents start to get involved, want to make sure that you're making all the right moves. So you're not jeopardizing the chances of more financial aid just because grandma and grandpa want to be generous. So again, there's going to be a timing aspect involved, as well. So this is why. Here's how the timing can be important. The FAFSA asks if anyone beyond the parents has contributed to a child's college costs in that year, the base year. So traditionally, the base year has been the calendar year before the child starts the new school year. For a student who was enrolled in college in the fall of 2016, for example, the base year was 2015. So consequently, if a grandparent helped with college costs in 2015, that would have been reported on the FAFSA for 2016-2017 school year. And this money, as you already learned, would have been treated as the child's income and have stiff penalties. So, so just as an example of ways, and I highly recommend, considering speaking with someone. Obviously, you can reach out to us, like I said, and just making sure that we're understanding, as this factor or grandparents start to become a factor in contributing, which is great. Making sure that we're positioning ourselves in a way that, even especially here's timing is a big part of that we make sure that we help you get through that and position yourself the best way possible. So so and then that all becomes part of like a strategy. So and part of that might be contributing to a 529. So, the timing of it, getting money, a lot like the UTMA and the UGMA accounts, the custodial accounts, is, looking at it now, make sure that we're being strategic and getting the money into accounts in the position where it's going to be addressed at the lowest percentage in that 5.64% or 5%. And a lot of times it does involve a 529. So, if you are in that situation, I wouldn't shy away from it. Just also understand that, considering these, there are going to be specific strategies that might help you position yourself best to get the most aid. So big influences of financial aid. So here are the biggest ones. So income from your tax return, of course. Parental non-retirement assets, including 529 accounts. We also talked about the number of children in college, big factor, and the children's assets and income. So those are the four main first things we're going to look at to make sure that we're in a position and looking at all the and trying to address each one and really position ourselves within each of these factors to receive the most aid. The ways financially. So parents are often, they're curious about ways to boost their chance financially. So maximizing eligibility for financial aid can often be tweaked, here and there, share a few possibilities. So attention to the calendar. There's one that the FAFSA is going to be, coming up, and then, they're just real quick, there is the money will the better. So you need the clock starts to tick. So the base, for students in college for the 2021-2022 school year will begin 2019. So it's your income in 2019 that will matter. So when you're looking at that, they're going to be dating back. So you're looking at that income, roughly 2 years before. So that's because the financial aid system now requires parents to use their 2-year-old tax returns, referred to as prior taxes, instead of the most recent. The federal government made the significant change so the financial aid process wouldn't be so rushed. So they're looking at, well-established, obviously you know exactly what your income was in that year, and it makes it a little bit easier for them to kind of like move through this process. So, if you are in a situation where the family's income increased quite a bit, this does play in your favor, of course. Since your financial situation can change, particularly since financial aid will be dependent on an old tax return, you can ask for a professional judgment from a school if your financial situation has changed. So you can actually ask them and circle back with them if your financial situation has changed significantly. And then example, obviously you can probably dream up some examples here. So if there's a significant change, if someone lost their job significantly and they're looking at 2 years before, it can play into your favor. The 2 years before can play into your favor, or it can play against you. And in those cases where it's playing against you, there are ways around that as well. So the second part is going to be minimize capital gains. So if you're hoping to qualify for financial aid, it's best not to sell investments in a base year that would generate capital gains in taxable accounts, because these profits, if they're offset by investment losses, will be treated as the investor's income. So they are going to, the formula is going to take into play those, and this will just reflect on your taxes. So when a family needs to sell investments to cover college costs, they should try to balance the assets they tap from investments that have generated gains with those that haven't. So losses can offset capital gains up to $3,000 in income, and any excess capital losses can be carried over to future years. So that $3,000 is just the max in that year, and if there's more in that year, it can be carried over to the next. So again, if this is any of this is a little complex, and you have some questions about how if you're selling some assets and how that might play into it, definitely let us know and reach out. We'd be happy to answer any questions around that. And then you want to be strategic, when you're filling out these financial aid forms. You're expected to report the value of your assets on the day you file the FAFSA. So it's better to submit the application on a day when the stock market has performed poorly, or you have paid your bills. Now I know this sounds like a bit, but every little bit counts. For financial aid purposes, the lower the account balances, the better. So the same goes for any money in your child's accounts. So if there's an opportunity or you need to pay down those certain bills with some of your child's money, or move the money around, always goes back to looking at that 5%, getting those assets that they're going to be looking at as low as possible. And these are some of those factors. And the biggest one, and just to reiterate, is going to be that 20 and 25%. So really, the first thing we want to look at is, and not to be redundant, but just to make sure that we're looking at those child's assets. And because the 20% versus 5%, it's obvious why we're going to be looking at those. But if you wanted to, if there is something coming up, even buying a car, just like, a way to draw down the money that your child has in their accounts, just definitely, definitely spend those down first. And then I already mentioned October 1st is when everything opens up, and there is an advantage to getting in there early. So if you haven't applied, apply as soon as possible. Look at some of the possible schools. If you're only looking at schools that require a FAFSA, of course, just fill that out. Make sure you understand if the CSS profile is going to be important. If you're in a divorce situation, understand the non-custodial application consideration. But yeah, get in there and apply as soon as possible. So, in closing here, it's extremely difficult to qualify, for some of these credits, and just some of these credits. Sometimes we get these questions from parents. Is some parents hope their teenagers can be declared independent students so they can qualify for need-based financial aid. But earning that designation will be impossible for most teenagers. So, if that was a consideration or a question here, on the slide, you can see that the types of requirements necessary to become an independent student, and they're just, in most cases, just outside of the realm of possibility. So that brings me to the end here. Of course, like I've mentioned several times throughout this presentation, feel free to reach out to us if you have any questions at all. Like, just don't be shy. We love to answer questions, whether you're a client or not, or even considering being a client. We just want to add as much value as we can and help you through this process as much as we can. But feel free to email me directly at John, JOHN, @bautisfinancial.com. I invite you to go to our website, bautisfinancial.com. There's tons of resources. On that page, you'll find our college planning hub, and you'll have, there's a replay of a webinar we did earlier, I guess a couple weeks ago. We'll have several blog posts, updates on deadlines, and just a lot of really great information as you're going through this process. So I invite you to check that out. So thanks for joining us today. And yeah, like I said, again, reach out to me at John, JOHN, @bautisfinancial.com if you have any questions. All right, we'll talk to you soon. Thank you.